Ever feel like the stock market is speaking some language you just can't crack? Well,
Yeah.
today's deep dive is all about that.
Okay.
It's about cracking the code with the Wyckoff method.
Right.
You want to get inside the minds of the big players.
Yeah.
Right. We're talking about the movers and the shakers, those composite operators, as Wyckoff called them,
Yes.
who are often several steps ahead of us.
And the beauty of Wyckoff's work is that it's not some dry academic theory.
Right.
Richard Wyckoff built his method from the ground up by being in the thick of it on Wall Street in the early 1900s. He was watching. He was learning from the best.
Yeah.
And he realized that these big players, they weren't just throwing darts at a board.
They were leaving footprints, right?
Yeah.
Like a trail of breadcrumbs.
Exactly. And Wyckoff believed that once you understood the motives behind those big moves, you could actually anticipate them.
Oh, wow.
It's like having a glimpse into the future,
Right.
or at least a much clearer crystal ball.
Okay, that's what I'm talking about. So how does this whole composite operator thing actually work? Are you telling me these big institutions are basically playing chess while everyone else is playing checkers?
In a way, yes.
Okay.
See, Wyckoff realized that stock prices aren't just random. They're driven by supply and demand. And these big players with their massive resources can influence both. They accumulate huge positions very quietly, often when the stock seems weak or unnoticed.
So they're essentially creating the lows.
Precisely. Then, once they've got their positions, they start creating the conditions for a price rise. They might spread rumors, release positive news, or even manipulate the price themselves to draw in other buyers.
Wait, hold on. Are you telling me these big players are intentionally trying to scare everyone else out of the market so they can scoop up cheap shares? That's ruthless.
It might seem that way, but remember, it's a game of perception. Wyckoff wasn't trying to have moral judgment. He was simply trying to understand the mechanics of how these big players operated so that others could level the playing field.
Knowledge is power. I'm starting to see why this method has remained relevant for over a century. It's like learning the secret handshake of the market movers. But how do we actually put this into practice? How do we start spotting these footprints you're talking about?
That's where Wyckoff's charting tools come in. He wasn't just a keen observer of human behavior. He was a master chart reader. He believed charts were like X-rays, revealing the underlying structure of the market.
So he wasn't looking at those squiggly lines the same way most of us do, huh? What was different about his approach?
He used a few specific types of charts. You've got your classic bar charts. Those are the ones everyone knows, showing the open, high, low, and close for each day, plus the volume. Those are great for spotting short-term trends and those key support and resistance levels.
So those bar charts are your go-to for spotting those short-term moves, right? I'm always looking for those support and resistance levels. Those are gold.
Exactly. But Wyckoff also used something called point and figure charts. Now, these are really unique because they completely ignore time.
Really? So if it's not about time, what are we looking at?
Pure price action. Point and figure charts only record significant price movements, filtering out the noise of those little back and forth fluctuations. They help you see the bigger picture, like the accumulation and distribution phases we were just talking about. And even better, they can help you identify potential price targets.
Okay, now we're talking. It's like those charts have a built-in crystal ball or something. Tell me more about these price targets.
Well, imagine you've spotted a stock in the accumulation phase on a point and figure chart. By analyzing the width and height of that consolidation, Wyckoff believed you could get a good idea of how far the price might move once it breaks out.
That's incredible. So we've got our bar charts for the day-to-day and point and figure for the big picture. Did he have any other tricks up his sleeve?
He did. Wyckoff also used something called wave charts. Now, these are really cool because they track the combined price movements of leading stocks within a specific industry.
It's like taking the pulse of an entire sector.
Precisely. Wyckoff believed that by analyzing the length, direction, and volume of these waves, he could gain insights into the overall psychology of the market and identify optimal buying and selling opportunities.
Now, that's what I call getting ahead of the curve. So he's got these unique charting tools, and he's using them to track the movements of these composite operators. But how did he put it all together? Did he have a system, a framework for making trading decisions?
He did indeed. In fact, Wyckoff had a very specific 5-step approach to analyzing the markets and finding those high probability trades.
5 steps to success. You know I love a good framework. Let's break it down. What's the first step?
The first step is fundamental to any trading approach. It's determining the market trend.
So are we talking bull market, bear market, or just chilling out in a trading range?
Exactly. Because trading a bull market is completely different from trading a bear market, right?
Right.
You wouldn't want to be buying into a downtrend any more than you'd want to be shorting a stock that's about to take off.
Right.
Wyckoff believed that once you identify the prevailing trend, you can significantly increase your odds of success by aligning your trades in the same direction.
Go with the flow, right? Don't fight the tape. Okay, so we've determined the trend. What's next on our Wyckoff checklist?
Step 2 is all about identifying those standout performers.
We're talking about the stocks that are really showing their strength within the broader market, right?
Exactly. Wyckoff called this identifying strong or weak stocks. But it's really about finding those relative strength champions. These are the stocks that tend to outperform in an uptrend. And of course, you can flip that around and look for stocks that are showing relative weakness in a downtrend if you're looking for shorting opportunities.
Relative strength. I'm hearing that term everywhere these days. So we're not just looking at the biggest gainers or losers overall. It's more nuanced than that.
Much more nuanced. Wyckoff was looking for stocks that were showing strength or weakness relative to the overall market or their specific sector. He compared their price action, their volume patterns to get a sense of which ones were truly in play.
It's like those horses that are just chomping at the bit to get out of the gate, right? You just tell they're ready to run.
Perfect analogy. And once Wyckoff identified those promising candidates, he'd move on to step 3.
So I'm picking my strong stocks. I'm seeing that beautiful consolidation. What's the next clue I'm looking for to know it's time to make my move?
This is where those point and figure charts really shine. Wyckoff's third step was all about selecting stocks that had a cause. Now, this doesn't mean they had some noble backstory, but rather that their chart patterns were telling a compelling story, a story of accumulation. He'd specifically look for stocks that had been consolidating for an extended period, forming a tight sideways trading range on those point and figure charts.
The longer the base, the bigger the breakout, right? Like that coiled spring analogy.
Exactly. And the wider that trading range, the more potential energy was building up, suggesting a bigger move was on the horizon. He used those charts like a detective, looking for those telltale signs that big players were quietly accumulating their positions, preparing for a breakout.
Okay, so we're seeing that consolidation, the tension is building. How do we know when it's about to spring? What's step 4 all about?
Step 4 is where we separate the wheat from the chaff, where we determine if a stock is truly ready to move.
So we're not just jumping in blindly after a period of consolidation. There's more to it.
Much more. Remember, those composite operators, they're smart. They'll often test the waters before committing to a big move.
What do you mean test the waters? What are they looking for?
They want to see if there are any more willing sellers out there, anyone who might try to get in their way once the price starts to rise.
It's like they're flushing out the weak hands, right? Making sure the path is clear for them to make their move.
Precisely. And they do that through a series of buying and selling tests.
Okay, so we're getting into the nitty-gritty now. What do these tests look like on the charts? How can we spot them?
Well, there are a few classic Wyckoff patterns to look for. One is called a spring, and it often happens near the bottom of a trading range. Imagine the price suddenly drops below the recent lows on light volume, almost like it's trying to shake out those who are getting nervous.
It's like the big players are giving the market a little shake, just to see who falls out. If the volume stays low, it tells them the coast is clear to start buying.
Exactly. And then you have the opposite, which Wyckoff called an upthrust. This happens near the top of a trading range. The price surges upward, often on increasing volume, sucking in all those eager buyers who think the breakout has arrived.
They're getting faked out.
In a way, yes, because what often happens next is the price quickly reverses and falls back into the trading range, trapping those overzealous buyers.
So the key is to watch the volume, right? Heavy volume on a spring suggests a lack of buying interest, while light volume on an upthrust tells us the sellers are in control.
You got it. It's those subtle clues that separate the amateurs from the pros. And that brings us to Wyckoff's fifth and final step, timing your commitments.
Okay, so we've done our homework, we've identified the trend, found our strong stocks, seen the consolidation, and spotted those buying and selling tests. How do we know when it's finally time to pull the trigger?
This is where Wyckoff brought it all together. He'd wait for confirmation from the stock's price action in relation to the overall market trend. He had this saying, the law of cause and effect. Essentially, he believed that every significant price move was preceded by a period of preparation, a cause that could be observed in the charts.
So it's not just about jumping in on any random breakout. We're looking for a specific sequence of events.
Exactly. And one of the most powerful tools he used to illustrate this was something called the Wyckoff wave.
Okay, you're going to have to break this down for me. What in the world is a Wyckoff wave?
Imagine a series of waves crashing on the shore. Each wave represents a cycle of accumulation and distribution. Wyckoff would analyze the length, height, and volume of these waves to determine the strength or weakness of the underlying trend. He compared the effort, meaning the volume, to the result, meaning the price movement.
So if we're seeing a lot of effort but not much result, that's a warning sign, right? Like those discrepancies we talked about earlier.
Exactly. It suggests that something's off, that the big players might be losing interest. But if we see the effort and result moving in harmony, that's a sign of a healthy trend. And it gives us more confidence to enter a trade.
I love how he's using these analogies to make it relatable. It's like suddenly I'm not just looking at charts anymore. I'm seeing the market breathing, moving in these waves. It's a whole new perspective. You know what's really clicking for me now?
What's that?
It's like this whole time I've been trying to predict the future of the market. But Wyckoff is saying, hey, the future's already written.
It's true. Wyckoff believed that the market was a reflection of human behavior, and that human behavior, especially when it comes to greed and fear, tends to repeat itself.
So those patterns, those footprints we're seeing on the charts, they're not just random squiggles. They're like psychological tells.
Exactly. They're giving us a glimpse into the minds of the big players, telling us what they're thinking, what they're planning.
It's like we're learning to read their poker faces,
Yes.
except their faces are these charts.
And once you start to understand that language, those subtle signals, it's like a whole new world opens up.
Okay, so let's talk about two of the most important phases in Wyckoff's world: accumulation and distribution. We've touched on them, but I think it's worth diving a little deeper.
Absolutely. These two phases are at the heart of Wyckoff's method because they represent the periods when those composite operators are most active.
Right, because that's where the big money is made. Or lost, depending on which side of the trade you're on. So let's paint a picture for our listeners. What does an accumulation phase actually look like on the charts?
Well, imagine a stock that's been beaten down. Maybe it's been in a downtrend for a while. Sentiment is pretty negative. Most people want to sell, not many want to buy.
Sounds like the perfect opportunity for those savvy composite operators to swoop in, right?
Exactly. They see that negativity as their chance to start accumulating a large position at a discounted price. And they're patient. They're not in a hurry.
They're playing the long game.
Right. So on the charts, you'll typically see a sideways trading range, where the price is bouncing back and forth between support and resistance levels. It might look like the stock is just drifting aimlessly.
But beneath the surface, the big players are hard at work.
Exactly. They're quietly buying up all the shares they can get their hands on, often absorbing any selling pressure that comes their way, and they're doing it in a way that's designed not to attract too much attention. They don't want to tip their hand just yet.
So they're being stealthy. What are some of the key things we should be looking for to spot accumulation in action?
Well, volume is crucial. During accumulation, you'll typically see relatively low volume, especially compared to the previous downtrend. It's like the selling pressure has dried up, but there's not a lot of buying enthusiasm yet either.
It's like the calm before the storm.
And speaking of storms, this is where you might see those classic Wyckoff patterns we talked about earlier, like springs and upthrusts.
Right, those buying and selling tests. So even in the midst of this quiet accumulation phase, there's still some drama unfolding on the charts.
Absolutely. Remember, those composite operators are always testing the waters, making sure the coast is clear before they make their big move. They might push the price down sharply on low volume just to see if anyone panics and sells their shares.
So that's the spring. They're basically shaking the tree to see what falls out.
And if the volume stays low, it tells them the weak hands are gone and they can start to drive the price higher.
Got it. Okay, so let's say the accumulation phase has run its course. The composite operators have quietly built their position. What happens next?
That's where we move into the distribution phase. And this is where things start to get really interesting.
Okay, because now the goal is the opposite of accumulation, right? They're looking to unload those shares they've been collecting.
Exactly. They want to distribute those shares to the public, ideally at a much higher price than they paid for them. And to do that, they need to create some excitement, some buying frenzy.
And that's where those psychological tactics come into play, right? The rumors, the news releases, anything to create a buzz.
Exactly. They're masters of manipulating sentiment. So, on the charts, you'll typically see a breakout from that sideways trading range, often accompanied by a surge in volume.
So it looks like the stock is finally waking up after a long nap.
Exactly. And as the price starts to climb, they'll use a variety of tactics to keep that momentum going. They might create those upthrusts we talked about, those sharp rallies that draw in unsuspecting buyers.
And then, just when everyone's convinced the uptrend is unstoppable, they start quietly distributing their shares into all that buying enthusiasm.
Precisely. It's a classic case of buy high, sell low for the retail investors who get caught up in the hype.
So the key takeaway here is that volume is king, right? If we see increasing volume on rallies that fail to make new highs, or heavy volume on those upthrusts, that's a red flag that distribution might be underway.
Exactly. It's like the air is slowly being let out of the balloon, even if the price is still holding up for now.
Wow, this is all starting to make so much sense. But I have to admit, it also feels a little overwhelming. I mean, how do we even begin to put all of this into practice?
Well, the first step is simply awareness. Now that you understand these concepts, these phases of the market cycle, you'll start to see them play out everywhere.
It's like learning a new language, right?
Yeah.
Once you know the words, you start hearing them everywhere.
Exactly. And just like learning any new language, it takes time, practice, and a willingness to make mistakes. Don't expect to become a master chartist overnight.
So don't beat ourselves up if we don't immediately start seeing those Wyckoff waves crashing on our charts.
Not at all. The key is to be patient, to keep studying, and to keep practicing. Go back and look at historical charts. Find those classic Wyckoff patterns and see how they played out.
It's like we're detectives looking for those subtle clues, those footprints that tell us what really happened.
And the more you practice, the better you'll become at anticipating those moves before they happen.
So to wrap up this deep dive, I think the biggest takeaway for me, and hopefully for our listeners, is that the Wyckoff method is about more than just technical analysis. It's about understanding human psychology, about seeing the market from a completely different perspective.
It's about getting inside the minds of those who are playing the game at the highest level.
It's about recognizing that there's a rhyme and reason to the seeming chaos of the markets.
And once you start to see those patterns, those footprints, you'll be well on your way to becoming a more confident and hopefully more profitable trader.
So keep those charts handy. Keep studying those Wyckoff principles. And most importantly, never stop learning.
Because in the market, as in life, the more you know, the better your chances of success.
Wise words to end on. Thanks for joining us on this deep dive into the fascinating world of the Wyckoff method. Happy trading, everyone.